We are absolutely going to see more bank failures unless there is a fairly precipitous decline in the interest rate, which would skate those banks back onside. I don't think that the Federal Reserve wants to lower the interest rate because the Federal Reserve is still concerned about inflation. The FDIC has to manage this crisis, both because of its own resources and because they don't want to see a crisis in confidence. But the truth is that the Fed brought this this problem on itself in the sense
U.S. regulators have seized Republic First Bancorp, opened a new tab, and agreed to sell it to Fulton Bank, underscoring the challenges facing regional banks a year after the collapse of three peers. Rick Rule, founder of Rule Media, discusses how this banking crisis will likely unfold and what's next for the economy. Republic First Bank, a regional lender based out of Philadelphia, became the first bank failure of 2024 on Friday when it was shut down by Pennsylvania's bank regulator, and the Federal Deposit Insurance Corporation, FDIC, seized control of the operation. In early March, Federal Reserve Chair Jerome Powell delivered a somber warning to the Senate Banking Committee, highlighting the persistent threat looming over smaller and medium-sized banks for the foreseeable future. He emphasized the enduring challenges of high interest rates and commercial real estate issues in the banking sector. Less than 2 months later, the United States experienced its initial bank failure in 2024. Rick Rule's cautionary message underscores the inevitability of more bank failures looming ahead, necessitating the FDIC to address the crisis with both its own resources and the imperative of maintaining confidence in the financial system. He places the blame on the Federal Reserve for the current state of affairs. Hundreds of small and regional banks across the U.S. are feeling stressed. Christopher Wolfe, managing director and head of North American banks at Fitch Ratings, cautioned CNBC that there's a possibility of witnessing certain banks either faltering or, at the very least, falling below their minimum capital thresholds. Rick points out that elevated interest rates escalate the funding expenses for banks, simultaneously diminishing the worth of loans granted during low interest rate periods, consequently fostering imbalances between assets and liabilities. Let's delve into the video to gain further insights.
We are absolutely going to see more bank failures unless there is a fairly precipitous decline in the interest rate, which would skate those banks back onside. I don't think that the Federal Reserve wants to lower the interest rate because the Federal Reserve is still concerned about inflation. So they're in effect stuck between a rock and a hard place. If interest rates stay high, the funding costs for the banks stay high, while the portfolio values of loans they made during periods of low interest rates fall, which is to say their liabilities overwhelm their assets. It's a very difficult conundrum for the Fed. The banks don't need to write off the losses. The banks do need to publish the amount by which their loan books are underwater. And so you have independent rating agencies, including Fitch, that will show you that the aggregate pro forma loan losses on some banks' books exceeds their equity. In other words, it's apparent to the market that these banks are zombies. The other thing that happens is that to the extent that your cost of capital exceeds your return on capital employed, you don't have the money to make new loans, which is to say your failure, or at least you're being tripled, becomes a self-fulfilling prophecy. And we're seeing that across American banking. What we're seeing really among banking investors, community bank investors in particular, and also sophisticated depositors and sophisticated borrowers, is a return to quality. You're seeing very high quality community banks, things like Farmers and Merchants Bank of Long Beach, First National Bank of Alaska, banks that have always balanced their assets and liabilities, have always maintained good equity slices, and have never engaged in these crazy time spreads, do very well. You are seeing other banks that were too aggressive paying the penalty for being too aggressive.
Nearly half of Republic Bank's loan book is linked to commercial real estate, a sector strained by the COVID-19 pandemic. Consulting firm Claros Group's analysis of approximately 4,000 U.S. banks revealed that 282 of them are vulnerable to the combined risks of commercial real estate loans and potential losses due to rising interest rates. The majority of these banks are smaller lenders with assets totaling less than $10 billion. In the event of a bank failure, depositors covered by FDIC insurance will receive compensation of up to at least $250,000 per depositor, per FDIC-insured bank, per ownership category. Rick suspects that the fallout from this situation may not be limited to smaller banks with market capitalizations below $1 billion. Even larger banks could face challenges, leading to a temporary loss of competitiveness. Now, let's redirect our attention to a video.
The difficulties that seem to be emerging around commercial real estate, in particular the office market. I was not too long ago in Manhattan, and I know that anecdote is not the same as statistic, but I was in a sort of a B-grade office building, Midtown, and that office building was 12% occupied.
Mm.
There is no way that that building meets its operating expenses.
This is recently, Rick? Recently?
Yeah,
Okay.
3 months ago.
Okay.
Never mind services its debt. And I do believe that in some markets, and I'm not an expert on commercial real estate, but I do believe in some markets that the other shoe is yet to fall with regards to commercial real estate, and that's impact on some banks' balance sheet. My suspicion is that the carnage there won't be restricted to banks with a sub-$10 billion market capitalization. It may be that the mega banks are too big to bail out. But the truth is that I think that some of the big banks will, for a time, become less competitive too, as a consequence of strains on their own balance sheet. I think that this will be felt throughout the banking system. By the way, much to the benefit of sanity-based banks. Most people will be taken care of. It's worthy to note, by the way, in the bankruptcy of Silicon Valley Bank, that the politicians decided that even the jumbo depositors, the politically connected, the important depositors of Silicon Valley Bank should be covered. So while federal deposit insurance only covers deposits up to $250,000, when it's bad politics to allow depositors to be punished for being non-judicious or stupid, the government bails out those depositors too. If you see a rank of bank failures, and if you see declining confidence in U.S. capital markets and the U.S. dollar, I think that you'll see the Fed forced to cave politically and lower interest rates. If the economy continues, at least statistically, to be in relatively good shape. I say statistically because there's a big variance in the United States. There are a lot of people doing very well, those people who have marketable skills, and there are a lot of people doing very poorly. So while our economy is performing extraordinarily well statistically, it isn't performing for all Americans. And to the extent that that dichotomy, among other things, causes a deterioration in the confidence around the U.S. political system and the U.S. economy, I think that you'll see the Fed forced to lower interest rates. And if you see them forced to lower interest rates, like they were in 1975, I'm old enough to remember that, I think you'll see real fireworks in the gold price.
A report posted on the Social Science Research Network found that 186 banks in the United States are at risk of failure or collapse due to rising interest rates and a high proportion of uninsured deposits. According to the report, if half of the uninsured depositors quickly withdrew their funds from these 186 banks, even insured depositors may face impairments as the banks would not have enough assets to make all depositors whole. This could potentially force the Federal Deposit Insurance Corporation, FDIC, to step in.